Welcome to a Wiser Retirement Podcast. We put together a guide with some recommendations to help you focus on being financially fit at different milestones in your life. Some of you may be ahead of schedule, while others may have to play catch up. You can download this guide for free on our website. The link to download Your Path to a Lifetime of Financial Success is listed in the episode description. Or you can go to wiserinvestor.com, scroll to the bottom, and find it there. Now on to today's episode.
Welcome to a Wiser Retirement Podcast. We believe the best financial advice should always be conflict-free. I'm your host, Casey Smith, guiding you to financial freedom. Today is my co-host, Brad Lyons. Hey, Brad.
Hi, Casey.
Today we're going to talk about financial planning in your 60s. This is a series that we're doing on planning at different age groups. And Brad, I think you just mentioned it's getting real.
It is getting real now. We're in our 60s, retirement tunnel. There's light at the end of that tunnel, and I can see it coming.
You know, for many people, this is when they start doing financial planning. The average age of our client here at the firm is probably around 55, 58. Trends down each year as we bring more clients on in their 30s and 40s. But, you know, this is the time that you ought to have the game plan together and know what's happening. But if you don't, it's okay. There's still opportunity.
There's still time. There's still time. And that's the important thing. We'll probably talk a lot about this, but now's the time to put together a plan if you haven't put one together yet. You know, we've been working now for 40 years or more, preparing ourselves for this point in our life where we're about to go into retirement or step into that next stage of life where we're looking for income from other sources other than earned income. Okay. And how do we put that together? And what's our plan for all this? You know, it's not as simple as it was when perhaps your parents and my parents, retired. It just isn't. The complexities involved with making decisions around retirement have increased tremendously from then. My father retired back in the early 1990s, he had a pension and Social Security. That's all he needed.
Yep.
He had a great time.
Yep.
He loved retirement. He never worried once about it. But then again, he didn't have to worry about some of the things such as healthcare costs that have, skyrocketed, inflation, volatility in the stock market, producing income from a portfolio that you can count on year after year after year, and some of these other things. So the complexities have surrounding retirement income now have increased to the point where getting the help that you need from a professional financial planning firm such as ours, okay, it's a good idea.
You know, it really starts with understanding your expenses. Most people will say, well, how much do you think X amount? Do you think 60,000 a year is enough? Do you think 150,000 a year is enough? Do you think, whatever number they come up with? And every family is different. So you have to, in your early 60s, you need to be establishing what is it costing you to live. And the budget is not the bare bones number. You can do that if you want, but ultimately it's, what is it that you need to live on a monthly basis or annual basis that's your target lifestyle. And that's a realistic budget and plan for the unforeseen as well. The big thing to the budget is, what payments are you making that you don't need to be making? So if you have car note, you have a mortgage still, if you have personal loans, all that stuff really needs to be cleared out. And that's a part where we help a lot of our clients, especially on the house part. So how do we get the house paid off? It seems that more and more people, though, have been coming in with homes paid off already, which is very encouraging. We haven't had to fight them on on paying off a mortgage. I think a lot of advisors will tell you that, your portfolio can make more money for you. You're going to make a higher rate than the 2.5% mortgage you have, and then we'll use the portfolio to pay that off. And, our financial planning software and our common sense tells us otherwise, because it's really about cash flow.
Yes.
Retirement's about cash flow.
And anytime that you can reduce your outflow, you automatically thereby increase your net inflow.
Right.
Okay.
Right. Exactly.
And it's about net, in that sense. So
absolutely. And then of course the other part is, well, if I don't have my mortgage interest, then then I can't deduct it on my taxes. I'll pay more in taxes. And it doesn't make any sense. I mean, you don't get a dollar for dollar tax reduction for your interest. So if you're paying $5,000 a year in mortgage interest, you're probably only able to deduct maybe $1,500 to $2,000 of it. So I say pay $2,000 more in taxes and keep $3,000 in your pocket, because that money otherwise would have been going to the bank, right?
Yeah. So now in the tax structure that we're under currently, where the standard deduction, has increased so dramatically over the past couple of years.
Right.
Plus, in retirement, you get another tax, deduction on top of that.
Right.
For being retired.
Right.
So it actually increases to actually hit that nut. That's a huge mortgage.
Yeah,
and that's a lot
mortgage.
of interest that you're paying.
Right. Yeah. No, if it's an investment property, I see that's a little different. That is a dollar for dollar reduction versus your income, plus the depreciation of the property. But and you don't live there. If you had to turn in the keys, maybe you're not that much worse off. Where your primary home is a big problem. Also, this is the time to figure out if you're going to be working longer. This is where the retirement planning comes in. Is like, if you need to work longer to either pay off debt or save more in your early 60s, you need to have that game plan, partially for your own career. If you know that you're going to go to 70, you might need to tell somebody that, because people in the office might be looking at you going, oh, he's probably going to be out of here in a couple of years, So you need to have that career plan in place of how you're going to get to 70, if that's what you need to do, is work until 70.
So for every year that a worker continues to go to work every day, let's look at what happens there. One, they decrease the stress on their investment portfolio.
Right.
Because they're not making withdrawals. Two, they're adding another year of contribution into their 401k. Okay. Three, in an upward market, you're getting potential gain, capital gain, interest, dividends, et cetera, added to your portfolio. And four, you're deferring Social Security for one more year. And we're going to talk a little bit about Social Security later. But there's a lot of benefits to working one more year. If you're able to do it, you enjoy what you do, and it's not physically taxing on your body, so it's in such a way that you cannot manage it anymore. So a lot of benefits to working one more year.
Is also, if you're going to be working longer, is it, do you make a job change in your early 60s? Because I would think 65 and later, it's a lot harder. People don't want to hire 65 plus year olds. So that's a real thing. So I that's something you can consider, or maybe can you go part-time and still not live off the portfolio and kind of, that part-time income. Typically that works well for people who are already debt-free. They're just going to, maybe they've been making $150,000 a year, but they just need about 40, to help supplement income for the first few years of retirement. That's always an option as well. And speaking of taking Social Security, it's always better to delay it. You want to wait till 70 unless you absolutely have to have the money, meaning you can't live, you can't work, you've come to the end. Maybe you've been laid off in your early or mid 60s. Then maybe that makes the case for it. But general rule is, in talking to the masses, is always delay till 70. And that's because between 67 and 70, you get an 8% increase per year in your benefit, plus whatever the inflation rate is. For the people waiting this year, between 67 and 70, they'd be getting a 15% increase.
Something like that. It's a large increase this year.
Yeah.
Okay, it's huge. And by deferring it, out a year or two, or all the way to age 70, you may be taking larger withdrawals from the retirement account. But as soon as Social Security kicks in, you reduce those withdrawals dramatically. Okay,
Absolutely.
and then you have the longest period of withdrawal time, because we're planning out to age 95. So we're looking at from 70 to age 95, 25 years of reduced payments, at that point in time.
And we're still in the time period where a lot of people are still, husbands are have been making more than the women have. And so therefore their Social Security benefits are higher. So that's another reason to wait till 70 is, let's say your wife is maybe in better health than you. Statistically, us men, we do stupid stuff, so we die earlier, right? I saw this thing on Facebook where a guy had a ladder leaning up against a window, and then he took another ladder, connected it to that window seal to go up to the other side of the roof. And the caption was, "This is why men die early." But for whatever reason, we tend to check out sooner. So remember that your Social Security, your wife gets, or your spouse, if the wife has made more money and has higher Social Security, your spouse gets the higher of the two. So if you pass away, then if your Social Security is higher, she would drop hers and she would get yours. So if she's going to live, 10 years longer, then you would want her to have that higher payment. So it's not just your life that we're calculating on; it's really on both lives. And
right.
You think about nursing homes are so expensive. It could be that extra in Social Security really makes a big difference when having to cover things for end of life, or if someone's in a nursing home for a prolonged time period. But certainly, delaying has a lot of positive benefits. I've had other people do like calculations with even in Excel spreadsheets. They're saying, well, I'm going to take this money and I'm going to just invest it. So I'm going to take it at 62 or even 65 or 67. I'm going to invest it, and then I'll do better, right? Actually, you don't.
Right.
We've talked about this in prior podcasts. I think when Matthews was here, he even did that study for us as well. But you actually cannot keep up with the markets with the increase that the government's giving you. You'd have to be 100% equities, and you'd have to be invested at just the right time. As you're rolling the dice, I take the guaranteed 8 to 15% each year.
You're rolling the dice at a time where you can least afford to do that,
right,
because your time frame is shortened. Because it's not that you're looking at age 95. Now you're just looking to the age where you want to begin supplementing, the Social Security that you're getting,
right, with
the fund that you have been investing, and then making that last for age 25. So that time period is short.
Yes,
it's no more than 8 years, by nature, 62 to age 70.
Correct.
That's a short time frame. And you better be a darn good investor. And we know that the individual investor, has troubles with that, because a lot of things get involved with investing, such as the financial aspect as well as the psychological aspect. And probably that's the larger one of the two.
Psychologically, absolutely. Another reason people say they want to take it sooner is so they can get it. If they're on the payroll, then the government can't take it away. And there's no foundation for that anywhere. Like, there's nothing that says that's a good idea. I don't know of any national commentator that would ever say that. So it just doesn't make sense.
Right.
It's something that we fabricate in our mind, and it's false. And that's what people tend to do who don't have the right data. Is they convince themselves with their own biases.
I was going to use that word myself. There's a bias that they've accumulated
right.
over time, and this is the way that they're making this decision. And literally, Casey, the decision on Social Security is going to be one of the most important retirement planning decisions that we make in our life. Because it's irreversible.
Social Security is funded by the people who are working. So it's not like your money went there and it was saved and it's yours on the other end. Your money was spent to pay people who had already retired. When they started this during the Great Depression,
mm-hmm.
people working paid into Social Security, which immediately paid into people who were already retired. That's how we got them off the soup kitchen line, right? Remember all those pictures from the Great Depression and all these people were looking for food and everything? Well, the older people, they started getting paid to be retired. This is where all this started. And so if they got rid of the program, we'd go right back to those pictures again. Because amazingly, I think 90% of people are going to rely on Social Security only during retirement. It's a huge number.
It's a very large number.
Huge number.
Yeah.
So this whole thing about, Republicans are going to take away your Social, no, they're not.
No politician is going to step up in that line and do that.
No,
whatsoever.
Nobody's going to do that.
No.
And as far as it being funded, you know what? Yes, we have no one's talked about it, but right now, 25% of the funding is going to run out in 2033. I think that has to be moved up closer because people, because of inflation.
Inflation's a huge one there. Yeah.
Also, too, people are making more money, so maybe that counteracts a little bit. But if it comes back, let's say it's 2031 or something like that, that's when they'll solve it. They'll solve it at the last minute, but it can easily be solved for people who are making over 150,000. We stop paying Social Security at 150,000. So if you're making 400,000 or 800,000, you're not paying into Social Security above that amount.
Right, above the 150.
Correct. So what they can do is just say, look, everyone's going to pay into Social Security no matter how much you make.
I saw a statistic on this, and it said that it solved 98% of the income shortage.
Yeah.
98% just by that one aspect.
Now, the people who are paying that will never receive that back out of the system. The
True.
reason why it's capped now is because it makes somewhat sense, because you'll now receive the maximum Social Security. If you pay in more, theoretically,
you'd never get that money back.
They'd probably want to increase the maximum, but they're not going to do that.
Right.
That creates more of a problem. So,
right.
But yeah, there's going to be a solution. Somebody will end up paying for it, but ultimately,
and you know that they've run many scenarios.
Oh yeah,
they have run all this through different analysis, and they've presented it to different committees in Congress.
Yep.
But Congress isn't ready to act on it right now.
No,
okay, because there may be a new scenario that comes out forward. So there's no reason to solve it now for a future event. That's just not the way Congress works.
I think some people say they don't want to take Social Security because this can be means tested. So if you're a person of means, which a person of means could be someone who has $150,000 to their name. I mean, it's amazing what the government comes up with when they decide who is a person of means.
That's a scary aspect. That's the one scary thing in my opinion.
So
get means tested.
So if it's means tested, then it's, you don't get it because you have these other assets. I just don't see that being as a feasible alternative. I'll tell you one thing: retirement plans don't work without it. I don't care how much money you make. I mean, you'd have to have probably 5 to 8 plus million in investable assets to fully replace Social Security
and to live in middle class.
Right. Correct.
Or lower. Exactly.
Yeah. So
it being a secure source of income is one of the more important sources of income that we have.
Correct.
Right. In the absence of pensions that, such today. So that secure source of income is a huge benefit, in a retirement plan scenario.
So anyway, I can talk to people individually. You'll talk to people individually, but ultimately, talking to everybody at once, you want to delay to 70. I think you have to start doing in your 60s is looking at Medicare. That's weird.
Yeah. This is one that people really want to avoid. Matrix approach to decision making here is huge,
it's hard to make the decision, but Medicare itself is a great program. It's great healthcare.
Oh yeah.
That's why people are trying to get it, to apply at 60 or before, or if you don't, Medicaid could be Medicare. There's a lot of things that people are trying to do to change it, but Medicare itself is a great program. Now you have to supplement that with a Medigap or Advantage plan. So the important thing to remember is you got to sign up for Medicare at 65, or there's a penalty later
Whether
on.
you're planning on using it or not, you still have to sign up for it.
So about 3 months prior is when you want to do that. Then you have to decide, well, if you're on your employer plan, some employers will say, okay, we're going to be the backup. And then some employers are, especially the bigger companies, they're still the primary. They don't care if you're on Medicare or not. So Medicare kind of becomes the backup. So you have to figure that out with your HR department on what you should sign up for. But then if you're retired, you're going to need a Medigap plan or an Advantage plan. This is where you get into alphabet soup. And we have a whole podcast on this in our archives. But really, Medigap tends to be more expensive, but it covers a lot more. Where the Advantage plans are very cheap, but there is a little bit of a gap there that could occur if you have high medical costs. So that's something we have professionals that we refer out to help people make these choices, because there's so many different ways to do it. There's some plans that are free, cost you nothing. But if you go to the doctor, it'll cost you something.
There's a cost somewhere in this.
So those are things that you have to kind of figure out based on your situation. And there are periods where you can't change back. Once you make a choice, you can't move back. So the decision is very important. But if you need help, always reach out to us and we can connect you with one of our Medicare specialists that would be able
Planning
to
for
walk you through
healthcare in retirement is a large aspect. It's huge, and it needs to be considered as a planned expense, whether you use it in any given year or not.
Right.
That you can expect to probably use it. If you don't, you didn't have to use it, but nonetheless, it needs to be planned for. It can't really be oops, we had an unexpected medical expense this year.
Correct.
Right.
Correct.
That can ruin a plan.
Another thing too is you might be your final look at long-term care. It's I don't really have a rule of thumb on Medicare or long-term care. I just know that so many people need it, but then they can't afford it, and it's too late to get insurance when you're in your upper 60s or certainly in your upper 70s. I'd say if you can't afford the premiums, I mean, you pay the premiums, but then you have to take away something in retirement that you're just plan on going on state health care in that case, because you don't want to be eating ramen noodles and not taking trips because you had to pay your long-term care premium.
Which in the end you may not need.
Yeah, that's true.
Right.
You may not need. If you're more on the wealthy side, you've got assets, let's say $10+ million, then there's other plans you can buy that are one-time pay. You write a check for it. If you pass away and don't ever use it, then it pays your beneficiaries back your premiums plus a little bit more. But those policies are more expensive, but it's a good safeguard to help protect the assets. And then for everyone else in the middle, there's many different options. But you're probably looking at $3,000 to $7,000 a year to cover a married couple, depending on how much benefit you're looking for. So that's something that you might want to start considering, certainly by the time you're in your mid-60s, is the long-term care options. Something else that people often talk about is the portfolio's changing. I got to get, I'm retired, I got to get super conservative. And we push back on that pretty hard because really retirement's a great event for you, but your portfolio itself, it's not really, shouldn't change that much. Your portfolio is just now coming to work. It's got to work for you for 30+ years.
That's the primary purpose of our portfolio is to
Right.
pay us income.
Right. And this environment's starting to change. We're starting to see higher yield on bonds, at least right now. Mm-hmm. But really, you need stocks. You need that growth in the portfolio to keep up with your expenses. It's not an income portfolio that your grandparents had.
Right. Exactly. Portfolios today, of course, need something called total return investing, which means it's growth and income in order to produce the required rate of return to pay you that income, a stream of income over the next 25, 30 years in your retirement. So it's total return investing, which includes stocks and bonds. To have a portfolio that you are expecting to receive only dividends and interest to supplement your income, that portfolio today would have to be huge.
Yeah.
Millions and millions of dollars. That would be nice to have, but it's not realistic for most people. So, therefore, you need to look at it.
If you had millions and millions of dollars to build a dividend, live off your dividends only, you're leaving so much growth on the table.
That you're just giving away in the end.
Yeah, I know, right? I'm just like, why wouldn't you just have a normal portfolio at that point and be focused on growing it for the next generation? So, not that dividend investing is dead. I'm not saying that.
No, not at all.
But and it's had a good year. But if you did that for the last 10 years, you were greatly missing out by double digits.
Yes, and you're not taking full advantage of the wealth that you have and that you've accumulated to support yourself in a higher lifestyle without increasing the risk of your portfolio whatsoever.
Correct.
Yeah.
Correct. Yeah. I've always seen it as your portfolio stays the same. I mean, for more wealthy clients, maybe you work in like a vacation rental property in there or something that generates more passive income. But it just doesn't make sense to me to be going, 70% bonds or 80% bonds and saying, I'm going to live off this interest. That's your portfolio of the 70s and the 80s. And that doesn't work anymore.
Right. Those rates are gone. As we talk, we're preparing the portfolio for retirement, which means that over the years, in our earlier years, there's probably a ratio of greater stocks than bonds. And it continues for a very long time. But as we're going to our 50s, 60s, and nearing a retirement, we want to sort of phase that portfolio into what the ultimate target will be for the rest of retirement. It's not you're fully aggressive until age 65 and then boom, you sell it all and recreate a portfolio.
Correct.
We don't want to be that disruptive in portfolios. Transitions are difficult in portfolios, and it should be taken, should not be taken lightly.
I mean, there is a time period you're coming out of maybe 100% or 90% stock, and you start ticking it down.
You start trimming it back a little bit.
But there's opportunities for that. You don't want to do that now in the lows of the market. That doesn't make any sense.
Right.
Do you need to start building cash though? In your 60s, you need to start making sure you have a good cash reserve going into retirement, because you will need a cash bucket to use, so you don't have to rob for the portfolio at the worst possible time.
Exactly.
I think one thing I will add is just make sure you define a purpose for yourself in retirement. So, I always joke, I give clients, I say, I give you 2 weeks on the couch or in the recliner. But after that, you got to tell me what your purpose is, because, I worked with a client over at Lockheed. He worked at Lockheed. He was in the Skunk Works. So he's designing the next thing to blow up the enemy, I guess. But he was in his 80s. He was still working.
Yeah.
He was having to take his pension. He was forced into taking his pension, his RMDs from his IRA, right? And but he was still making like $250,000 a year designing, badass bombs, I guess.
Love what you do, and you never have to work a day in your life.
Well, I think he did love it, but his wife says he can't quit. He can't quit. And for the first couple meetings, I was like, man, this lady's pretty hardcore. I mean, she must have big expenses and doesn't want him to take a reduction in income. That wasn't it at all. It was the fact that when all his buddies quit or retired, they all died within a few months. Like every one of them, there's 3 of them, and they passed away within months. And so, it's you quit your life's work, but then you go into the next phase. You still have to have that purpose. What's maybe what is it? Is it your handicap? Is it get your golf handicap down? Is it being physically fit? Is something you're going to focus on? Is it grandkids? Is it fishing in certain spots of the country that you've been trying to do but never had time? It could be traveling. It could be a lot of things that now define what your purpose is every day. But your feet got to hit the floor in the morning and go, okay, I got to get this, and this done. And I'd say most of our successful retirees who are happy, who are healthy, every morning when they wake up, they know exactly what they're doing.
They have a list of things to do. After working for 40 some years, every day, Monday through Friday, and sometimes even more, to all of a sudden stop is a shock to the system.
Yep.
Okay. And that's why people have some health issues afterwards, is their system is trying to catch up with what just happened.
Right.
Yeah.
I always get sick over Christmas. Because I go all the time. If it's not wiser, it's something with the kids, right? And my two oldest, their sports require a lot of traveling, so I'm always on the road. But yeah, Christmas comes and it's shut down for a week. I always get sick, so my body's like, oh, we can rest now. But yeah, same way for retirement for our pilots as well, because they're traveling the world, and all of a sudden airplanes are moving without them, and it's kind of a weird feeling, because you thought they needed you all these years.
Right. We hear the term a little bit, like our next chapter. Okay, it's like flipping the page, and it's a new chapter in a book. In our lives after 65 and 70, etc. Okay, what is it that we're still passionate about? And it doesn't have to be 40 hours a week worth of passion,
right?
But it can be something where we're going to take up an activity of some sort, be it social, be it or tactical or constructive than that, but do something, and then treat it like, don't say work, but treat it like your joy.
Yeah,
in life.
Absolutely.
Yeah. What a wonderful opportunity.
We talk about this other places, or talk about retiring in your 60s and other places. We have 2 podcasts that we referenced in our notes here. Episode 115, what could happen if you don't prepare for retirement. Episode 103, your pre-retirement checklist. Also, don't forget, we have a YouTube channel. It's called A Wiser Retirement. We have a couple of videos there. Are annuities good are annuities a good retirement strategy? And the answer is no, but you can still go watch the video if you'd like. 4 steps to financially get organized before retirement. I think I'll add that as a bonus point here, Brad. It's also time to simplify things. Get your estate planning done. Let's get down to one checking, one savings. Let's get all our retirement accounts consolidated. Let's have one login to see everything. That's simple is good as you start aging. So,
it is, quite frankly. It minimizes the decision making.
Yeah, absolutely.
Right.
All right, Brad, enjoyed the conversation. See you next time.
Sounds great.
Thanks for listening to a Wiser Retirement podcast. We hope you enjoyed today's episode. Make sure to subscribe wherever you're listening, that way you don't miss any new episodes. We would also appreciate if you could leave a rating and review. If you have any questions about anything that was discussed today, head to wiserinvestor.com and reach out. We would love to hear from you. This episode was produced and edited by Lilton Moore.